Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Douglas Lloyd, CEO and co-founder of Azoomee. Hello, Douglas.
Hi, Alex.
So tell me, what is Azoomee?
Azoomee is a kids platform focused on fun learning that includes games, educational activities, videos, and a parent-approved instant messaging service within it. It's in 110 countries, and it's available in any app store.
Okay, so why did you set this up?
Well, really personally, I have 3 young children, and I've realized from my own experience how difficult it is to find content that's both educational and fun. The internet is littered with digital content that's free, but it comes with adverts, inappropriate content, in-app payments, you name it, and often access to people that you shouldn't know or be in contact with. So what you're looking for and what parents are need are services that actually address positive screen time and get their children in the right place, enjoying the right content and having the right kind of experience as they move through primary school.
So how does the service actually work and how do you make money?
So it's a subscription-based service, and as I said, it's available in the App Store. In the UK it's £4.99, in the US it's $6.99. The price varies depending on the country where available. But essentially it's unlimited access to premium games, videos and educational activities. We refresh it all the time, so always adding new content. That gives parents that peace of mind and also the fact that they know that there's always something new for their kids to do.
You say it's a subscription service, but who do you sell to? Are you selling directly to the children's parents, or what? How does it work?
Well, we're fortunate to have 2 business models, and the most obvious model would be direct to consumer. As I say, consumers hear about us. We work with the NSPCC, for example, one of our supporters, and so people hear about us and they go to the App Store and they subscribe directly. But our core market to start with, which really has built up a very stable and high growth revenue base, are working with channel partners. Channel partner like O2, for example. So with O2, we are selling what they call a family tablet bundle. That's a tablet, a low-cost tablet, which includes a 2-year subscription to Azoomee. Very good for O2, very good for us, guaranteed revenues for us, and that means that we get to millions of customers very quickly through these big channel partners.
And it's available in a number of countries, so is it a similar model?
Yeah, I mean, the beauty of how, as you'll know with a tech product, is that once you build it, the key is to leverage that. And so we have a platform that's highly scalable that we can deploy anywhere. As I say, it is deployed globally. If you want to buy it in Sweden, if you want to buy it in South Africa, you can today. But what we're looking for, and it's one of the reasons why we're so excited and with our business pipeline, is we're working with big distributors, telecoms, media companies to resell Azoomee through their channels in a variety of different business models. Could be revenue share, could be prepaid subscriptions to generate income.
So just explain to me, in the UK, how do I get Azoomee then? How am I most likely to come across it?
So it's very funny. In fact, your FD had that experience, and I'm delighted to say is an avid user with her kids. She started by using it through the App Store and subscribed as you would any app. So you go to the Apple iStore or to Google Play Store, etc., and find it there. But then she decided that in fact what she wanted to do was to buy a tablet for her kids that had Azoomee preloaded on it. So she went to the O2 store and she bought a tablet which included a 2-year subscription. So now 2 kids each have a tablet, and we've made revenues both through O2 and through the App Store.
And so how have you got to where you've got to? How much have you raised so far? How many people are in the business? And what are you going to raise?
Well, to date, the business is about 4.5 years old. We've raised £6 million to date, and the bulk of that has gone into the product. As I said, I think it's really important for investors to realize that this is, we don't have a startup product, it's commercially available. That's where most of the money has gone to date. And that's been raised largely from high net worths, and many of them, in fact, were in our previous business. As I think we had a previous business, we sold it successfully, and 60% of today's investors have reinvested in that 6 million.
What was that business?
That business was also a media business. It was more B2C, but it also used the channel partner model, which enabled us to get that really big, stable growth that we could count on, and led to a very successful exit. Coming back to your question on fundraising, we're looking to raise £2 million through Wealth Club. The purpose of that really is threefold. We need to hire more, we need to expand the team to execute on a number of the business development opportunities that we have in place, particularly reinforcing the marketing and content teams. We need to invest in certain content. We have a number of very interesting content deals lined up subject to this financing. And we also need to make sure that we increase our marketing spend so that the awareness of Azoomee goes up, particularly in those markets where we're already working with large partners.
And isn't it incredibly expensive to get this content?
So, well, actually, it isn't if you adopt the model which we've done, and that is that we license our content on a fixed model basis. So we have fixed operational costs. If we pay for content, be it video or games, we know what it'll cost us. It doesn't matter if 10,000 subscribers are looking at it or 100,000 subscribers, the cost of our content is the same. Your business model is really to get more and more third-party contracts rather, or are you trying for the direct-to-consumer? Where's most of the money going to come from? Well, the strategy is to start in a market, like for example the UK, where with a big partner, O2, and then to build on that with partners who can build the direct-to-consumer business. So if you take the UK, we have O2, that business is 2.5 years old, that contract continues to grow and is giving us revenues, but we've now signed a deal with Clear Channel, the outdoor advertising business, to work with us on building awareness and drive direct-to-consumer revenues. Both models apply to us, but what we're not going to do, and I think it's one of the big risk factors that we've removed from the business, is to spend a lot of money on social media spend, which we know doesn't really return the kind of rewards that investors are looking for. So what are the risks for investors? So I think, I think the biggest risks for investors are that one, that we don't necessarily get the access to capital that we're looking for, because that means that we can't execute on recruiting the right person or getting the content when we get really interesting deals, and I expect that risk to go away with this fundraising. I think more strategically, when we're working with large partners, we move at 100 miles an hour. They don't always move at 100 miles an hour, and sometimes you need to recognize that your pipeline needs to be broader to know that, yes, this telco is going to come on board, but they're not going to launch this quarter, they're going to launch the quarter after. And that's something which is harder to mitigate, and that's why we've worked very hard in the last 6 months to build our pipeline. And do these telcos, do they measure the number of people downloading the app, the number of people using it? Is that important to them? They measure three metrics. The first metric is they like to look at how is the product regarded on their own online stores. So if you take we're averaging over 4 out of 5 in all of our products. So they're looking at that. They're looking at can they grow a sustainable revenue base out of it, and we've proven that as well. I think the other thing is, how does it help them in the positioning? The telcos as an industry they're in some difficulty because they're like utilities. Why would you use Vodafone rather than O2, rather than Orange, rather than EE? The truth is, it's often about price. So content differentiates them, and the family segment is a rich segment for them to go after, and we help them do that. Clearly, this definitely appeals to parents. It definitely appeals to the telcos. What about children? Because I've got my own very young children, and whatever, they always end up finding a way to watch what they want rather than perhaps what I want them to watch. So, is that a risk? I wouldn't call it a risk. I'd call it a challenge. But what you have to look at is the mentality of Azoomee. We didn't build Azoomee as a parent's product. We built it as a kid's product, and therefore, everything we do at Azoomee in terms of product enhancements to the user are how will the kids find it more fun, how will they feel that it's a fun experience, not how do they think it looks more and more like an extension of school. This is something that adults don't always completely understand, that you need to create a product that, like ours, which is in the nexus of entertainment and education, it needs to blend the two. So everything we're doing is to make it look lively, personal, fun, and that's critical for them. And we can see from the engagement that kids love it. So who would you say your competitors are? So we're in a space which is largely occupied by a small number of private companies that are, as I've said, looking not at pure entertainment nor at the curriculum. And there's a huge chasm between the two. People will think of Netflix, they're not a competitor, they're just video and they're just entertainment. Or they might think of Bond, if we're talking about UK investors who produce lots of sort of curriculum-based tests. Right in the middle of that is a huge opportunity which isn't yet really being tapped. There are a number of businesses that are looking at that. They're small, they're privately funded, the majority of which are going for the under 5s. We're focusing on the over 5s, which is also more attractive to channel partners.
Okay, and you say Netflix isn't a competition, but surely someone like them can get more appealing content than maybe you could.
So I think it's important to decide, to look at where we sit from a curation point of view. Netflix, I think we'd all agree, is an entertainment service. It's certainly not, they do obviously have documentaries for adults, but certainly if you ask a kid what it is, it's about cartoons. At least, unlike YouTube, they don't have adverts, but most parents buy Netflix for themselves, for House of Cards or something like that. Netflix also doesn't have all the multimedia that we have, so they're single media play, like YouTube, for example, and therefore they're not exactly what kids are looking for. Kids are very, very interested in gamification, games, ways to communicate. Netflix doesn't have that. It would have to create a completely different platform, and in fact, that's one of the things that gives us one of our great barriers to entry, this very sophisticated platform that we've weaved together over the last 4 years.
So how big do you think you can get this company?
Well, I think that the sky's the limit is probably overdoing it. But when I look at our projections of 20 million in the next 3 to 4 years, this seems to me like a very credible revenue opportunity. When I think of the individual opportunities with cable operators in the US, with telcos in India, with the partners that we have, the opportunity is enormous, particularly as you just lay one subscription revenue over the other. And of course, if we do become, as we aspire to be, the global edtech player looking at primary school children, there's the ability to morph into selling all sorts of other services as well. So right now, Azoomee is focused on one particular thing, but there's quite a lot more we could do.
And what would an exit look like, do you think?
So we've looked very carefully at this. We have the nice thing about the edtech sector is it's pretty hot. Everyone can see that education is increasingly digital. So obvious acquirers are the traditional educational players who are looking for online offerings to supplement everything that they've done historically offline. But next to them, we know that we are known, I suppose, by large content businesses that are looking to find digital solutions for their library, content aggregators who are looking for a kids platform to use that has the kind of engagement metrics that we have, and because we're very games focused, a lot of games publishers know us too. So I'm pleased to say I think there are a diverse number of companies who could find it very valuable to buy us rather than to try and repeat what we've already achieved.
And if I invest today, when do you think hopefully I could get my money back?
Obviously, as an EIS investor, you wouldn't want us to exit before 3 years. But I would say certainly within 5 years, because this is a fast-moving market.
And the sort of returns I could without going mad.
I think based on pipeline, the leverage nature of our product, I think a 6+ times exit is of the current valuation is a very credible scenario. And if we get a lot of buyers out there and we really accelerate on those projections, we can beat that.
Good. And if I'm going to invest in an EIS this year, just tell me a little elevator pitch. Why should I invest it with you?
I think there are 3 reasons. It's very simple. You've got an experienced management team who have credibility in kids media, technology, and entrepreneurship. We're after all sold one. We've got a proven product. We've got growing revenue. We've got blue chip partners. And lastly, we're operating one of the highest growth markets currently available in the technology space. So proven market, proven opportunity, high growth market. Looks pretty good as far as I'm concerned.
Douglas Lloyd of Azoomee, thank you very much.
Thank you very much, Alex.